Japanese stocks rose after Wall Street climbed overnight, while Japan display shares jumped on hopes that Apple may use liquid crystal technology in one of its new smartphones. The Nikkei ended 1.4% higher. Hong Kong stocks rose the most in 2 weeks, aided by a sharp rebound in Tencent's holdings and that better than expected China November trade data. The Hang Seng Index was up by 1.2%. Mainland China stocks also ended higher. The Shanghai Composite Index gained 0.5%. And over in the US, Wall Street stocks rose yesterday, buoyed by popular tech companies including Facebook and Alphabet. The index gains suggest that investors are not overly worried about tonight's deadline by US President Donald Trump and Congress to pass fresh spending legislation. If they can't agree on the terms, parts of the federal government could shut down. The Dow Jones Industrial Average rose by 0.3%, the S&P 500 gained by the same margin, and the Nasdaq Composite Index added 0.5%. Well, global markets are broadly in positive territory today. Bourses in Europe opened positively on news that Britain and the EU have agreed on a divorce bill and are ready to move to the next phase of negotiations, which would include their trade relationship. Here at home, the all-share index was only just in the black, but has since dipped into the red, being dragged down by financials. Now, in the meantime, the local currency has firmed against major currencies relative to last night's York close, which may have a bearing on a weaker equities market today. And to add to Steinoff's woes, Moody's chopped the furniture retailer's credit rating down by 4 notches to a level termed speculative. The share fell by a further 45% this morning. Let's take a look at the indicators. Well, I'm joined by Warwick Lucas. He's the Chief Investment Officer at Galileo Capital. Thanks for joining us, sir, as always.
My pleasure.
Good stuff. Let's take a look at the global market, its performance in general in the past week and the key drivers that you've seen.
All right, so the US a generally flat week. We've seen a slightly stronger week in Europe, perhaps some confidence ahead of the EU Brexit negotiations there. So positive week there, and I think the euro also slightly weaker, which is also positive for them. It's too strong a euro going to constrain their economic activity. So
indeed. Now the US dollar is firmer on the government there talking about introducing an infrastructure plan in early new year and also those tax cut plans, and the markets are pricing in a definite rate hike by the US Fed next week. Does this spell trouble for emerging market countries like South Africa?
Well, certainly it shouldn't be a surprise. I mean, it's been very well telegraphed. I mean, forward rate agreements were already giving a 97% chance of a hike about 3 weeks ago. So I guess this one was always expected to be in the bag. But it doesn't mean that it's a start of a swift series of hikes. So at this stage, I wouldn't expect too much disruption of markets from that.
Now, but if those two things do come to reality, it's going to mean that the US economy has much more inflation because it's highly liquid, which means that you're going to automatically get higher interest rates there. Well,
it certainly can trigger economic activity. I think the key point being, though, that if we look, for example, at wages, I mean, they've been relatively muted. So technology, for example, is weighed on the wage spiral side of the equation. There's things like gig jobs and so on, which are really quite poor quality and don't have a lot of pricing power.
And then here at home, that stock that we haven't stopped talking about, Steinoff, it traded as low as R5.50 today. 8 days ago, it was at 55 Rand a share. Can this stock really recover, and does it mean, what does it mean for its underlying operations, you know, the stores that it actually runs? And because, of course, workers are concerned that they may lose their jobs.
All right, so as far as will the share price recover, etc., I mean, this is a company that in the last few weeks has proven a few times in a row that just because the share price has halved, it can't halve again. It can. I think as far as the future of Steinhoff goes, the clear question to be resolved here is how are debt holders, whether they be bankers or whether they be bondholders, how will they deal with the issue? I think the issue of Moody's cutting the credit rating, I think it's very important that actually comes out, because that would be one of the starting points at which you could then start having discussions about financing. Clearly, Steinhoff is going to need some kind of refinancing. I do think there's a lot of value inside the business, but if a cash crunch gets out of control, it could take a bad situation and make it worse. I do think it has the capacity to get out of the trouble, but it's going to need a lot of honesty, a lot of humility, and a certain amount of latitude now from its creditors.
It may sound a bit of a cheek for a layperson like myself to ask this question, but why didn't people from your community, the asset management community, why didn't they see this coming, as people are suggesting that there were so many red flags? How does a company begin to be investigated as far back as 2015 for irregularities and nobody seemingly worry about it?
I think for a long time it was quite unloved. Over the years there's been many quite snarky comments about its accounting. It made it more difficult in that it was accounted for almost like an investment company, which makes looking through the financials very difficult. It certainly wasn't highly rated for a very long time as well. But certainly the listing in Germany was possibly a pivotal point in that we saw investigations by German tax authorities in the late 2015. And then also the manner in which, for example, they made acquisitions like a quarter of PSG, which was a very strange acquisition, which should actually raise questions as to why on earth would a furniture-focused company make an acquisition like that. So I think there were a lot of people who were nervous, and it showed up in the rating, but unfortunately that sometimes gets confused as value instead of a value trap.
And what could the asset management community learn from this experience, since we, ordinary lay people, depend on you guys to invest our money properly so that we get a return on our investment?
I think the main thing that can be learned is to keep on digging, demand answers from management, and when you don't get them, kick the tires harder.
Another company not doing so well, EOH. It's a software technology company, falling by over 30% yesterday to around 45 rands per share. What's the storm there?
All right, so most of the stink seems to be related to an acquisition that they made in 2015, a company called Grid Technologies, which at the time they acquired for 870 million rand. Sounds like a lot of money, but relative to EOH, it didn't even rate a SENS announcement because it was a relatively small drop in their bucket. Nevertheless, it seems that news has come out relating to Grid in relation to SABC tenders, which are now clearly under a very sharp microscope. The numbers being bandied around are fairly large, but nevertheless in the overall scale of EOH, I would have thought that the market response is a bit overdone. But of course, in the wake of the carnage in Steinhoff, I mean, it's spread quite wide. Any company that's had a whiff of bad corporate governance around it has been cut to ribbons.
Indeed. Well, we're going to leave it there. Thank you very much for your insights, as always, sir. That was Warwick Lucas, Chief Investment Officer at Galileo Capital. After a short break, Nzinga has more business news for you. Have a fab weekend.